Hi, everyone, and welcome to our second episode of the Digital Disruption series. Continuing with the BFSI theme, today I'm going to bring to you disruption in the insurance sector focused on property and casualty insurance. Now, amongst all the insurance verticals, property and casualty is one sector which is probably the most innovative, where we see a lot of interesting business model which have sustained over time. And I have the privilege to bring to you the fight, or the tug of war between Insuretech and traditional carriers. At the end of the video, I'm going to talk about what's going to happen next and how should the incumbents respond. So stay put till the end of the video. Do comment, like, and share the video as you deem fit. And with this, we start our discussions, which are centered around today. It's around Insurtech versus incumbent general insurance providers. Now, this discussion has five themes, and we start with technology innovation, where we're going to talk about the use of multiple technologies which are changing the way customers engage with insurers on self assessment of assets and claim settlements. Next, we're going to look at challenger business models with some digital first examples, specific use cases of technologies in the form of great companies that have come up in this area, followed by market forces reshaping the industry and a peep into the Indian insurtech market. And finally, like always, and I'm going to talk about the implications for incumbent insurers and what's going to happen next in the sector. How are the incumbents going to respond and take a view on it? The first the first step is technology innovations using cloud and ubiquitous cloud and mobile. These all pervasive technologies have altered the way claims are settled and assessed. Before we move on, the insurance sector is wide and deep, and this is by no means supposed to be comprehensive, but to give you a sneak preview on the sector and what is happening currently on the sector. So you know, this is just one aid to your learning process, but not in any ways comprehensive. With that caveat, let me start with discussing Snapsheet, which is an insurance claims automation platform which uses virtual auto claims technology. Snapsheet's cloud SaaS digitizes the entire claims process. Example, car owners simply install the Snapsheet app, take pictures of the damage, and upload them along with vehicle information of the app. The app sends these pictures to the Snapsheet team, who assess the picture and releases an estimate in just a few hours, a process which could typically take days and weeks depending upon the complexity of the claim. Allstate's Quick Photo app does almost the same thing. Moving on, mobile telematics is the next big thing which is making our roads safer using data. Using artificial intelligence and mobile learning, companies like ZenDrive understand how people drive their vehicles and use insights, gathering behavioral data analysis. The company helps people to become safer drivers and understand the kind of risks they have while driving. Then, using these insights, it determines insurance premium. The next company, which is again, I'm very impressed with this company, is called Senitans, which is a data science and a behavioral science company that turns motion data into insights. It delivers insights on mobile intelligence, which is why and how people are driving, crash detection, which is real time detection, immediate notifications, reconstruction, and fast claims processing. The next group of companies that I'm going to talk about is in the home insurance sector, and I start with Hoover. Hoover empowers customers by allowing them to take ownership of the claim through a self-service model. It transforms the smart pictures of any property into an accurate interactive 3D model. Hoover customers use the app to update measurements to reduce claim adjusting cost, decrease cycle time, and customer experience. The other company that we're going to discuss now is Flyreel, which uses its mobile AI assistant, guides users through a comprehensive property scan. Its proprietary computer vision technology automatically extracts and indexes every detail of the property as it's scanned, including features, conditions, etc., for most informed underwriting decisions. Like Hoover, it also reduces the claims cycle time using technology. The next thing that is happening in this sector is using new sources of data. And an example is geospatial data and image classification. A company like Nearmap captures and manages actual images of urban sites which are sold as subscriptions. Insurance companies are increasingly using near map subscriptions to assess claims. Similarly, Shift Technologies is using machine learning and a huge pool of data to correlate multiple data points to insurance to fraudulent transactions, and it's a very important tool for fraud detection. Right. In the next section, we're going to talk about how digital first models are impacting the insurance landscape across three vectors, which is cloud and mobile, the classical vector, the second being data and AI, and the third is how they're redefining the customer acquisition process. Right, so hang on, and as I put up the slide, the way we're going to do this discussion is through a few examples, relevant examples of and use cases of these technologies. So Hippo is a online platform that offers homeowners insurance across a wide range of damages from structural to furniture, electronics, and water services. It does not underwrite the insurance by itself but relies on its partners to do so. To that an extent is similar to the OTT neobank model. Homeowners get a quote within 60 seconds after entering some basic data. It claims to save customers approximately 25% on their premium because majority of its operations are conducted online. Another amazing company in the homeowners and renters insurance is a digital first company called Lemonade, which is focused on urban dwellings. Homeowners and renters are covered against all standard perils, including theft, damages, liability, and can add extra coverage for valuable belongings. It's different from a traditional profit driven insurance model to the extent where a classical insurance company collects excess premiums as revenues. In Lemonade, policyholders insure each other. It's a pooling model, and Lemonade takes 20% of the pool. Every year, leftover premiums are donated to a charity of the pool's choosing, and it's called the Give Back program, which differentiates Lemonade's from other insurance players. Now we're going to talk about three other companies which are in the car insurance, and starting with Root Insurance. Root measures driver behavior and it's called Fair Insurance. It measures drivers' behavior across braking, speed of turns, driving times, and profiles drivers. Root requires drivers to download the app and perform test driving for several weeks while the app monitors driver behavior in the backend. Finally, the driver gets a personalized code based on how it drives. So it's actually rewarding good driving behavior and charging a premium for dysfunctional behavior. Moving on, Metro Mile is a pay-per-mile model. This model has a base rate which is based on a variety of factors like driver's age, credit history, type of vehicle, etc., plus a fee for miles you drive in a month. So the insurance you pay is largely correlated to your driving habits, and it does not have a flat fee that the traditional insurers charge. Kuva, another digital native in the car insurance space. It is a pay-as-you-go insurance model similar to some extent with Root, but it has a unique product called Kuva for Sharers, which is targeted to people who have a driving license but no car and want to use a car belonging to a third party. To summarize, these digital first models are becoming more and more customer centric, using data and charging a premium for positive behaviors, which differentiates them from flat fee based insurance products which are in vogue from the traditional insurers. As industries transform in the connected world with higher amount of device connectivity and asset sharing, it structurally changes the notion of risk and ownership. And demand for intangible assets and cybersecurity are also coming to play. So from a lot of lines of insurance which were personal lines, it is moving to commercial lines, changing the nature of insurance fundamentally. So in the next sections, we're going to talk about how market forces are threatening the classical insurance business model and therefore opening up an opportunity for classical insurance player, or a risk for insurance companies who cannot make the shift in the new normal. So here goes. The smart and connected and shared economy, a combination of them, is changing the patterns of ownership across multiple asset classes, which is called the changing of the insurable mask. And what is to be insured is something which is to be debated. Now, in terms of autonomous vehicle or autonomous mobility, will change the nature of driving errors in accidents, because as and when we go to fifth level of autonomy, accidents do occur. It will happen because of the car's structure and the way the device has been configured as against a driver error. So therefore the classical auto insurance will move from personal to commercial lines, and a huge market will therefore be disrupted. Similarly, ride sharing, fleet usage, and subscription based mobility will change vehicle ownership, and vehicle ownership will need to move from individualized to in the form of usage based insurance. Similarly, in home insurance, the use of Google Cloud based Next or Alexa will give you data about will the cost of connected homes will be lowered. Insurers can potentially use the data to devise behavioral nudges on practices which would lead to loss prevention, and therefore the amount of premium that has been charged would kind of change. Now, at the next part of the discussion, we're going to kind of focus on what is happening in the insurtech sector in India. Now, insurtech, like fintech, is also hotting up in the country. And so, what I'm going to do is use three examples to explain what is happening in the insurtech sector in India and what are the new business models that are coming into place. So, here goes. The first one is ACO. And ACO, probably all of you know, it is a D2C model selling auto insurance digitally. It's 8% of the online car insurance, and its USP is personalized pricing. Now, I used to buy in my car insurance from traditional users, and I have shifted to ACO primarily because of the seamless buying experience and the choice and personalization. So it's kind of a great product and easy to use, seamless, and distinctly digital first. All the benefits of digital first are accrued to this product. The second thing that they're working is third party micro insurance around products of other companies or services like ticket cancellation, ride and driver, where they have tied up with Ola, Redbus, Zomato, Urban Clap to deliver this service. The second one is kind of an OTT neobank model founded in 2017, and it's called Toffee Insurance. It's like their tagline is buying insurance is as easy as consuming a toffee. So the InsurTech provides micro insurance on events or assets which people cherish. Now it's very small insurance on small events which you need to be insured, but there are no standard products around it. Typically, like an OTT model, they configure this product for you and personalize it for you. And in the back end, they have insurance tie-ups with major companies like HDFC Argo, Tata AIA, Bajaj Alliance, Manipal Cigna for Health, and Future Generale. The third company, founded in 2016, Digit, is probably the first Indian general insurance cover provider, provides all kind of covers through the online mode, but also maintains a physical product team which has a 94% claims settlement. Now, these three distinct models, one is a D2C model, which is ACO, one is an OTT model, and the third is a full stack model. All these three models are prevalent and well funded, so their ability to sustain their cash flows over a period of time is also high, which augurs well for the insurance industry in India. The second important thing that is happening is the rise of the aggregators. From Policy Bazaar to CoverFox to Turtle Mint, it allows price discovery for any consumer. So you can go into a Policy Bazaar and look for the cheapest quote, which on the underline it will kind of throw up multiple insurance providers, and you can choose. Now this price discovery model is either to go to create a lot of commoditization of products, and that's where the risk lies. Now, moving on, all of this data, we have come to a situation where we need to answer the so what question. And in the next slide, I'm going to kind of try and answer the so what question. This obviously is based on my assumptions and a view of the future. It is not to be taken as absolute truth, and make your own conclusions, but listen to my provocative propositions if they sound good to you. The first one, incumbent carriers need to access customer data and personalized products. There's no way that you can run away from this. And to be able to do that, the technology architecture and the API architecture needs to be solidified so that an ecosystem model can be developed. Classical value propositions are dead. Need to sharpen it and build a multi-tier distribution model, not an only B2B or a B2B2C model. There is a huge play for a D2C model, which incumbent players need to think about. Commoditization of products are likely probably going to be a reality, with the policy bazaars of the world becoming stronger and stronger. The second important move is the understanding of an insurable mask. What is the insurable mask in the connected world and a world which is going to be highly digitized? This is a question that I had raised in the previous section of my video. It's a huge opportunity for incumbents. Insuretech is going to drive more micro insurance services because they understand behaviors of people, the consumption patterns well. That is going to eat away from the classical insurance landscape bit by bit. Need to be aware of it. Now, use of technology in the Indian firmament is limited to AI and big data use cases. Probably there are some which is around the others, but not very evident. So there is a huge scope of smart and connected IoT solutions, blockchain technology to create self-service and improve claim experiences. So in summary, differentiated business model, unique value proposition, change of technology architecture and API-led ecosystem framework. Micro insurance services are the key big themes emerging from that, from this sector. Hope you like the video, and if you like the content, share as you deem fit, comment, and in the next video we're probably going to come up with insurance, which is life insurance, life and annuity insurance. Watch the space for more videos, and thank you very much for watching. See you again soon.